Now, whether it's the iron condor butterfly spread or whatever name that's given it, right? Those are much more complex strategy. But right now, I'm going to share with you the very so-called maybe intermediate, right, option trading strategies. Okay, and these are called spreads. Spreads, Now, predominantly option trading spreads, right? There are 4 types. Yeah, there are 4 types, But I'm just going to share with you 2 types. Okay, so at least you learn 50%, right? Now remember, let me share with you the key intention is we are option seller. We do not do whatever spread, iron condor, we don't do it. And one of the key positive intention why I want to share with you this, right? So that in case somebody tell you, hey, this one you can make money. Yeah. So at least you already know. So that's point number 1. The second thing is when someone tell you that you can make 70, 80%, you have to be very careful because if it's really so simple, if it's really so easy, right? I think Temasek Holding also want to know how people do it. So you have to be very careful. Now, so the basic option trading strategy, right, is you can buy call option. Whether you can buy a short duration, in which just now I've shared using the Varigo, right? And you can buy a long duration. Yeah, long duration, right, which is bigger than 1 year, is also sometimes known as LEAP. And I'm going to explain what is LEAP. What does LEAP stands for, right? Yeah. So if you can do it for call option, whether short term or long term, you can also do it for put option, whether it's short term or long term. So what is LEAP? LEAP stands for long term with the L, equity, which is E, anticipation security. Now, if you look at this name, right? Long term equity, anticipation. So in other words, you're guessing, you're anticipating that something is going to happen. Whether is it whether is the share price going to go up or share price is going to go down. So anything, any option, right? Anything option where the expiration right, is 1 year or more is called a LEAP. Okay, so these are the basic strategy. Yeah. Now be very careful in case somebody want to charge you like 5K, 7K, 10K, right? And they say I'm going to teach you, that you can make 20% using LEAP or long-term call. You don't have to pay the amount. This is it. Okay, this is it. But remember, the risk reward you already saw, right? 100% risk, 23% reward. Okay. Now, so let me just go back to some fanciful strategy, right? Yep. Yeah. So what I'm going to share with you next is I'm going to share with you 2 spread strategy. And the first spread strategy is called a bull puts credit spread. Okay, I'm going to go really slow because if you have never done option trading before and all along you have been like faithfully following value investing, right? This will be mind-blowing. So I'm going to do something really slow. So from this point, I'm going to do really slow. Now, bull put credit spread. Now, forget about what the name is. Okay, Now, for those people who are watching this video, if you do not mind, please mute your... Yeah. So one more time, right? Is bull put credit spread. Now, this strategy consists of 2 parts. First part is you are going to sell a put option. Selling a put option. Now, and the other one is you have to buy a put option. But remember, as option seller, we only sell put, right? After we write, sell, collect money, we go and sleep already, right? But this fella, right, need to sell put and then need to buy another put, okay? And then you will see this term called ITM and then OTM. Now, what does ITM stands for? ITM stands for in the money. And OTM stands for out of the money. I mean, what is this? What is in the money? What is out of the money? Now, let me go back to the example about the Barrick Gold, right? Now, if you're logged in to any platform, you may see the option chain. And if you look at option chain, do you realize that there's always 2 shades of color? For example, in this case, you see the yellow one, right? You see a yellow and there's a white one, right? And then here you see the white one and then you see a yellow one. And then there is an invisible line right at the bottom. Okay, Now, it's as though there's an invisible line that cuts between the white one over here and the yellow one at the bottom. Now, when there's an invisible line over here, right, that means the share price is between 26 and 27. So that's one thing that you can observe from this option chain. So this is the first thing. Now, the second thing is what is this in the money? Now, any number, right, that has a yellow color, very easy to remember, as long as it's inside the yellow shaded region, is called in the money. One more time, as long as all the numbers that's inside the yellow region is called in the money. Very easy to remember. Inside the yellow, in the money. Outside, which is the white, right, out of the money. Okay, inside the yellow region, in the money, outside is out of the money. So let's go back to here. Now, here it says sell one put in the money. Oh, in the money is inside the yellow one, right? So maybe what this strategy is trying to say is, let me sell a put at a strike price 29, where it's in the money because it's inside the yellow. And then here, the step say, oh, right now I must buy one put out of the money. So in other words, I want to sell one that's inside the yellow, and right now I need to sell one that's outside the yellow, which is inside the white. So remember, sell one, the yellow one, buy one, the white one. Okay, white one. So right now, let me just go into detail. Okay, so remember, right, this bull put spread consists of selling, let's say, put option in the money and buy one put option out of the money. So ready? Now, let's say I'm option trader. Yeah. And I have this feeling that whether Biden or Trump win, the share price of this Barrick Gold, S&P 500, whatever stock they want to speculate, it will shoot up. And because it will shoot up, that's why I use a bull put. I don't use a bear, right? Because bull is going up. Yeah. So remember, only when you have some feeling, assumption, intuition that the share price will go up or whatever technical analysis, then you do a bull put spread. Okay? Now, so in other words, only when you're bullish, then you use a bull put spread. Okay? Bullish, bull put spread. Now, so you sell a put, and in this case, remember, option traders usually they do not have cash mentally prepared to buy stocks. So what do? They sell a naked put. So they sell a naked put in the money because it's inside the yellow, right? And then they buy a put out of the money. Yeah. If you go and click, right, remember, when you want to buy, you have to choose this one because the order will not be filled if you choose 0.91. Okay? So how do they make money? If they sell naked put in the money, and then they buy the put out of the money, which is a white. How do they make money? Ready? I'm going to go read it slow. Number one, let's say you do one contract. So what's your profit? You sell option, right? Correct? You make money. So it's 1.7 here. Okay? And then after that, you buy, you pay, right? Here is you make, here you pay $1. So it's 170 minus 100 equals $70. So you make $70. $70. Now, but so $70 is your net credit. Because you sell, collect money, and you buy, right? So you know in between there is a gap, right? You collect the gap. So this gap is like a spread. And because you collect money overall, that's why within this spread, right, you collect money. That's why it's called a credit spread. That's why this term here is credit spread. Okay? So how much ROI do you make? Hi, this is Kaden. Remember to click on the subscribe button and turn on the notification to be notified of our future training videos. And if you take this $70 divided by your capital outlay is $100, so it's 70%. So 70% is quite a lot, right? Yeah, but remember, $70 and 70% is you collect today. Yeah, today. And what do? You have sold option and you also bought a time bomb, which is a put option, right? Now, there are three scenarios. So let me share with you the best case scenario. So what's the best case scenario? The best case scenario is the share price move based on what you guess, you have speculated. So in other words, the share price shoot up bigger or equals to 27.5. So this is 27.5, right? Yeah. So this is a y-axis, y-axis, right? So this is the share price. So it shoot up. So if it shoot up, it looks something like this. It shoot up. So if it shoot up above this 27.5, right? So what happened? Number one. Okay, let me put this up. Your put option, whether is it the one that's being sold, whether the one that's being bought, it expires. Wow, so you hang. So it expired, what does it mean? Remember, you collected 170, you paid $100, you have this $70, right? Yeah. So 70 divided by your upfront $100, so you get 70%. Wow, so hang. So you did this and the share price moved according to what you have guessed. Yeah. And here we said ROIY is 70% because we are making an assumption, right? Yeah, that the option traders do not have capital to buy stock. That means whatever thing that they sold, the options are all naked. So that's why when you take $70 divided by a smaller base, the ROI is high. Yeah. Now next one. This is the worst case scenario. So what's the worst case scenario? The worst case scenario, right, is the share price go opposite of what you have speculated. For example, you guess that a pandemic will recover, then suddenly there's a second crash, and the stock market crashed. Yeah, instead of going up, it went down. So it went down. Pay attention to what happened. Let me go one by one, right? Both option will be exercised. Just now both option expire, right? Just now both option exercise. Now I'm going to go one by one. Now what does it mean? Number one, you sold naked put, right? You expect the share price to go up, right? But it didn't. It went down. So it stays below the strike price of 27.5. So what does it mean? That means after expiration Friday, the system will auto buy 100 stock for you because you sold one contract. Yeah, and assuming that inside you got no money, right? Because you're option trader, right? Okay, they will buy this 100 stock for you using margin. Yeah, and 100 stocks multiplied by 27.5. Yeah, so you use borrowed money to buy 2750. 2750. So this is number one. This was what happened to the naked put when it's being exercised. And then another one, right? Your put option that you have bought will also be exercised. So when your put option that's being bought exercised, what does it mean? That means at the same time, the system, right, will also sell the stocks for you at the price that you have stated, 26. So in short, over the weekend, right, the system do two things for you. Number one, buy the stocks for you at 2750 and then sell the stocks for you, right, at 2600. Okay? So you buy high and the system will sell low. Yeah. So what's your loss? Your loss is this minus this, right, equals to 150. Yeah. But remember, you have collected this spread upfront. Yeah, because one month ago you did this spread, you collected $70, right? So even though you lost 150 minus away 70, yep, so your loss is lesser. Okay, so your maximum risk, if you do this bull put credit spread, right, your maximum risk is $80. But remember, $80 is the absolute amount. So what is the risk, right, in terms of percentage? And because your capital outlay is $100 and you lost $80, so your maximum risk is 80%. Yeah, your maximum ROI is 70%. Got it? So far, right? So far. And remember, here we are assuming that you're not paying any commission or whatever, which may not be true. Now, but what happens if the share price go in between? It didn't move up, it didn't move down, and during the expiration, it just stays flat. Okay? If it stays flat, what will happen? Now, if it stays flat, what will happen is the sold put, right, the put option, the naked put over here, will be exercised at 27.5. In other words, the system will auto buy stocks for you, and since you have one contract, right, it's 100 stocks multiplied by 27.5, so the system will automatically over the weekend, buy the stock from you, and eventually it's going to cost you 2750. Okay. Now, so put option exercise only, but the bought put, which is here, number two, right, expire. Yeah. So expire, nothing happens, right? Remember, previously you kept this $70. Yeah, you did the spread, right? And then you make $70. So what's your ROI? Your ROI is this $70, right? Over here. Okay? Divided by, you have to cough out this 270, right? Yeah, because you have to go and buy the stock, right? Exercise, right? And then initially, when you go and buy option, you have this $100, right? So your capital outlay is 2750 plus $100. So 70 divided this, right, is 2.46%. Yeah, if the share price stay flat. Okay. Now, let's a summary. Bull put spread. Bull put spread. So if I summarize, the best case scenario is you make 70%. What lah? You have a boasting right? You go and put on a Facebook, hey, I just make 70%. But you didn't tell people you only spend $291. Yeah. Oh, I make 70%. I'm smarter than Warren Buffett. Okay. But remember, the maximum risk is 80%. And if the share price stay in between, lucky you can still make money, right? Yeah. Okay. Now, so the question is, remember, investment is always a risk reward. So that's point number one. And based on what Professor Benjamin Graham has said, the key philosophy behind investing, right, is not to make money. Yeah, is to protect the downside first. So the downside is already 80%. So how do you protect 80%? What you want is you want the maximum risk to be zero. To be zero, right? In this case, it's not. Yeah. So again, if you sell house, whatever, right, you got $1 million, will you want to play this game? So this is a bull put spread. Bull put spread. Now, so this is one so-called intermediate strategy. Now, let me share with you another one. Bear call spread. Bear call spread. Now, so bull put spread, right? Remember, is they are very bullish about a company. For example, some people, Maybe some people, right, want to try out Tesla, because they're very bullish on Tesla. Or they're going to use the bearish gold because Warren Buffett buy when it touch must become gold. Yeah, so anything bullish, they use bull put spread.